Ladies and gentlemen, welcome back to the channel. In today's episode, we're going to talk about this upcoming week, the big events that we have, the big catalyst, and why there's one reason in particular. There's a couple, but there's one big reason why I'm bullish for this week, and it comes down to the Fed, the summary of economic projections, and what the markets are currently expecting. Let me give you a little bit of a secret, long story short. It's going to be very hard to surprise markets bearishly this week. Okay? And if you're a little confused, I highly recommend you guys stick around to hear about exactly what we're talking about here. Now, there's other catalysts as well. There's big earnings. There's one company in particular for the AI trade. It's going to be massively important. So we're going to get into all of this in today's episode and why the stock market could go crazy next week. I mean, this is the last piece of the puzzle for a tactical year-end Santa Claus rally and one hell of a start to 2026, in my personal opinion. So we're going to get into all of that. Hit the like button as well as subscribe to the channel. Help push this out to more and more retail investors that need to hear this. I think hedge funds and institutions probably need to hear this as well, but they're probably not watching YouTube. Their loss. If you guys want to come trade and invest alongside us, check that link out down below in the description of today's episode as well. But with that said, let's get started. Okay, so honestly, like, where did we even start for this upcoming week? It's going to be a huge week. This week is going to be massive, and the following week is going to be massive and really set up this Santa Claus rally for investors. So I guess let's start with earnings. This is not really like my core bull thesis for this week, so let's start with this, although it could be part of it. Here you can see for this week, we actually have a bunch of earnings coming out. Monday and after hours, you have Toll Brothers. They're going to tell us more about the housing market. Now, one of the things that I am bullish on for next year that Wall Street is not talking about is if we do have inflation that comes down, if we do have Fed rate cuts, among other things like the Fed beginning to buy treasury bills more and more, you're going to see mortgage rates come down. You're going to see the mortgage market pick up, okay, the real estate market pick up. There's a lot of equity in people's homes, but like take this home for an example, right? I bought this home, like you would throw up if I'll just tell you. I bought this home for about $73,000. 3-bedroom, 2-bath. So yeah, I bought this house for about $73,000. I actually didn't even look at it before I bought it. I looked at the pictures or whatnot. I was a real estate agent at the time, so I kind of knew the details of it. The seller just wanted to get out. This was 2021, okay? And like, it needed paint, it needed new cupboards, it had not been updated since probably the 90s, right? So I basically stole the thing. Okay, the mortgage was around $450 when I bought the house, $73,000 or so. Put a couple $1,000s down on it. This house today is worth around $200,000, give or take, and I haven't moved since 2021. If you were to buy this house today, your mortgage is going to be around $2,000 a month, okay? I got originally this mortgage around $450. The home values in the area have went up. This home value has went up. So now it's like an $800 mortgage, right? The mortgage has literally like doubled just from insurance and taxes and all of that. Beyond the point, you'd still be paying a crap ton to get this same house versus 2021. Now, I could afford to buy a new house and pay the $2,000 mortgage. I've bought rental properties with mortgages a lot more expensive than this since 2021. But it's like, I'm thinking about things. If I was like normal income, normal family right now, like not an investor, just living, working and living, right? And I bought a house in 2021, mortgage $450. Today it's $800, and I'm looking at getting a new house similar to this, $200,000+. and they're telling me the mortgage is going to be $2,000 a month, a lot of people can't afford that, okay? Even if you have $150,000 in equity in your home, right? Now, you could always, like, pull equity out of your home. A lot of people don't want to do that because you effectively have to, like, refinance it, and your payment's going to be higher and all of that. So one of the big sleeper catalysts for next year is if real estate begins to pick up and treasury yields, effectively 10-year treasury yields, come down, then you're going to see people be able to buy homes again, right? Even if this mortgage was $1,500 a month, I think that makes a big difference between $2,000 and $1,500 for an average family. Okay, like we're not going back to crisis like 2021 mortgage rates anytime soon. Okay, but just to get the mortgage rate down to 5%, 4.5%, would do wonders for this real estate market and give people a lot more spending power when they sell their old home and buy a new home. Okay, so a big sleeper catalyst. That was a rant, but yeah, Toll Brothers could be important Monday and after hours. Tuesday, pre-market, AutoZone, Campbell's, Ollie's, couple companies like that. Tuesday and after hours, GameStop, Cracker Barrel, Casey's, Braze, Dave & Buster's. Wednesday pre-market, you have Chewy. Wednesday and after hours, Oracle, Adobe, Synopsys, Planet. Thursday and after hours, you have Broadcom, Lululemon, Costco, Restoration Hardware. I'm sure you guys already know what the big company is this week. If you don't, it's Oracle. Okay. And I know Broadcom's another big one. You know, Lulu, Costco, these are going to be important companies as well. Synopsys, recent partnership with NVIDIA. Okay. But it's Oracle. Okay. Oracle was a good chunk of the AI fears that we've had in the past 2 months. Okay, Oracle fell about 40% from its all-time high. At one point, Oracle was almost $1 trillion company. What happened in the last 2 months is Oracle was selling bonds to continue to grow the business, as pretty much all companies do. But for whatever reason, the investors that were buying Oracle bonds said, you have a higher risk of going defunct or, you know, defaulting over the next 30 years than you did before. So the rates on these bonds went from about 3% to 8 to 10% for the next 20 to 30 years. And you know, people are like, "Oh my gosh, what does this mean for the AI trade?" You know, it's one of those weird situations. Now, Oracle's going to tell us how their business is doing, typical earnings. They might address this recent issue in the bond market. They might not. But getting Oracle earnings is going to alleviate some of the fears of what in the world happened with Oracle's bonds. That doesn't happen too often when you just get a jolt of fear in a stable $1 trillion company. Like, especially in AI, that has not happened yet. But it did happen in the last 2 months. So I do think Oracle earnings on Wednesday could be quite impactful for the AI trade this week. Again, just for investors to figure out, you know, what happened. Like, is Oracle doing okay? The answer is yes, right? Oracle's doing just fine. Nothing has changed with Oracle. Bond investors had a little freak out moment. It happens in smaller companies all the time. But again, not in companies that are leading the AI revolution that seem to have a bright future ahead of them, right? That's what's unusual about that. Now, this upcoming week, we're going to have a bunch of economic data as well as the Fed. Okay, on Monday, you have consumer inflation expectations for November, expecting those to fall to 3.1%. We did see from the Michigan Consumer Sentiment Survey, inflation expectations for the 1 and 5 year ahead period fell to the lowest level in 11 months. Okay, we had challenger job cuts that came in really low, initial jobless claims that came in at almost a 5-year low. So all of a sudden, it looks like the economy is doing great again. Okay, we'll see what these inflation expectations look like, but the lower they go, the better, because expectations tend to precede reality, right? It's kind of like manifestation. If you, there's a great video on YouTube that all of you guys should watch. see if I have a free tab I can pull it up. It's Earl Nightingale, The Strangest Secret. If you guys have not listened to this, I've probably listened to this video 20 times over the years, okay? But basically, if you think about something hard enough and you want a goal badly enough, you will begin to build into that, right? Seemingly without knowing. Like, for an example, if you're a girl and you don't invest, you don't care about investing, none of that, you're gonna look at a product like another product, right? But if you're an investor and you see a product flying off the shelves, you're gonna look at that and say, oh, could that be an investment, right? Kind of like that. Expectations, your thoughts tend to lead to reality. So inflation expectations are important for markets from that perspective, okay? Now, on Tuesday, you have probably the biggest set of data this week with the ADP employment change. Last week, it was negative 13.5 thousand. This is kind of flew in the face of some of the data we've gotten recently showing the economy is doing well. ADP has been quite negative here, so we'll see what happens Tuesday. We do get JOLTS job openings for September and October, okay? The September reading does not matter. It's all about the October reading. The October reading is expected to show 7 million job openings, okay? A lot of people think these are phantom openings. They just never get filled. They're just there. We'll see. Basically, the more job openings, the better the economy, okay? The less job openings, the weaker the economy. This is something that would really move the needle in terms of Fed rate cuts for 2026, okay? And affect the Fed's commentary coming out on Wednesday. Now, it's not going to do anything for a Fed cut December 10th. I don't care if there's, I mean, there would have to be like 9 million job openings, something that would be like a black swan event to get the Fed to not cut rates December 10th. The probability heading into this upcoming week is 85% that we will get a rate cut December 10th. Okay. What's more important is January, March, April, June, like the next 4-ish Fed meetings. The data is going to move the probabilities for cuts at these meetings. Okay. And we'll get into that in just a moment. That's part of the bull case. The Fed, the bull case for this week, I should say. The Fed is on Wednesday. You get the Fed interest rate decision and the FOMC economic projections. Let me give you the reason why I'm so bullish on this week. One, the last Fed meeting, the markets took very poorly. Not too often do you have 2 Fed meetings in a row that markets take poorly. So number one, that right there. And I've just noticed that over time, right? If you have a really bad Fed meeting, markets don't like it, the next one is typically good. Only like 2022, I can recall, you had like back-to-back, Fed meetings that markets did not like. Like every time the Fed came around, it was like, oh my gosh, it's going to be another disaster, okay? Recently, it has not been like that. That's not what makes me very bullish, okay? It's not even the seasonals or the setup for 2026, the Santa Claus rally, none of that. It actually is in the economic projections and what the markets are pricing in for Fed policy. So again, you're pricing in a cut December 10th. Like that's going to happen this week, okay? The question is, what does the path forward look like? We get a summary of economic projections. So the Fed's going to give us a roundabout view of where they're expecting the federal funds rate to be. Now, keep in mind, we're going to get a new Fed chair, a new Jerome Powell, if you will, in May. So Wall Street's going to, kind of discredit some of this. But markets they do not have high hopes of Fed cuts next year, believe that or not. You have a 27.3% chance of a cut in January. So you're pricing in a pause. You have a 38.7% chance of a cut in March. So you're actually not pricing in a cut in January or in March. You are barely pricing in a cut in April. The probability of a cut is 40.3%. The odds of a pause, 36.4%. So you're pricing in a cut technically in April. Then you're pricing in a pause in June, okay? Then you're pricing in a continued pause in July. Then you're pricing in a cut in September, okay? And then you're not pricing in any additional rate cuts next year. So you're pricing in a cut in September, and you're pricing in a cut in April. That's it. You're only pricing in 2 rate cuts next year. Now, I think the highest probability is that's roughly what we're going to get in the summary of economic projections. Could we get 3 rate cuts priced in? Possibly. I don't think the Fed's going to have that much conviction to do that. But I think it's going to be hard to bearishly surprise investors next week. Like, if the Fed were to come in at 1 rate cut, that like 0 to 1, that would be a bit of a shocker. I guess. Again, we're going to be getting a new Fed chair, a new Jerome Powell in May, so that's going to change. So I think what you're going to see is a range, around 2, right? Between 1 and 3, that kind of equals out to 2, kind of in line with what the markets are pricing in. 2 rate cuts next year with a strong economy, likely inflation coming down, strong GDP. I think that's kind of going to be the narrative in the Fed's dot plot, that they're not concerned about the economy. They're not too concerned about the labor market, but they think inflation coming down next year is going to be enough to cut rates 2 times. That's going to be really good for markets, right? Basically just confirming what the markets are already expecting, okay? Like, I mean, it's going to be hard to bearishly surprise Wall Street next year, okay? And let me tell you, the odds of 1 cut versus 3 cuts are pretty similar in pricing. If you look at the December 9th federal funds contract, the odds of only 1 cut next year sit at 20.2%. The odds of 3 cuts sit at 24.7%. So you're honestly pretty close on both sides here. Like, it would be better if the Fed lets us price in 3 cuts. But if we only even price in 1 next year, you're not that far off of that pricing right now. Believe that or not. Okay, now no cuts next year, if that is what the Fed goes with, there's only a 7% chance of that. That would be a shocker, okay? Or if the Fed priced in, 3 cuts next year, that would be really good. If the Fed priced in 4 cuts next year, that would really be a shocker, okay? That I don't think stocks would do well if the Fed priced in 4 cuts next year. So that's part of the reason why next week is likely going to be a really good week, in my opinion. It's just going to be really hard to shock investors. And the Fed's probably going to be more in line than most people think with the market's expectation of 2 Fed cuts next year and a cut December 10th. Okay, mix that with the strong outlook for 2026, mix that with the tactical Santa Claus rally, the fact that hedge funds and institutions underperforming the S&P. They're not really allocated to stocks that much. There's a lot of people that are still underweight and are bearish. Tactically speaking, mix that with an in-line Fed meeting, and you're pretty soon here going to have a Santa Claus rally on your hands, in my personal opinion. Now, you're going to get some data out of September as well with the balance of trade, exports, and imports. This might tell us a little bit more about GDP, although, September's still Q3, so it's not going to give us too much of that. We're going to get more of the data that will tell us how GDP is going to look like in Q4 coming out on December 16th. So that's another part of the story here. The Fed doesn't have the data for September 16th, presumably, like the jobs report and the exports and GDP and all of that. So they're not going to want to surprise the markets in either direction, okay, because of how much the outlook could flip-flop. Not this week, but next week, okay, on December 16th. So I think it's going to be shockingly in line. And shockingly in line with expectations is plenty good for a rally, okay? And then on Friday, you have some Fed speakers, Fed Polson, Fed Hammock, and Fed Goolsby, that we'll be speaking. Now, Bitcoin continues to be volatile. Right now, it's at $89,800. You want to get back above 90,000. You want to ultimately see Bitcoin do well from here. Bitcoin tends to precede what markets do. So Bitcoin sold off from 94,000, sold off a little bit, and you had the risk on trade that faltered a little bit last week. If Bitcoin can recover here in the next 24-ish hours into this upcoming week, then you could see a much larger recovery, which again is going to help fuel that risk on area. And I think AI stocks, hyper growth stocks, quality of these are going to do very well into the end of this year. Now, as I've said before, I think you really need to see the entire market start to participate in this market rally to continue to extend to new highs and to break out. You've seen the risk on trade have a good 2 days last week. At least Thursday was really good. Lots of risk on stocks did well, and then Friday was a little bit of a give back to that. But I do think in this upcoming week, you're gonna really see those areas start to shine and outperform. Some of the stocks in your portfolio are gonna have some catching up to do. In my personal opinion, again, I'm not a financial advisor, I'm not a financial planner. Contact one if you don't understand what was said in today's episode. If you have anything to add to this, let me know down below in the comments section. With that said, have a great rest of your day and a great weekend, and I will see you in the next one.